I'm down a lot on the trade desk. I currently have 450 shares at an average cost of $35.56 and I'm down 33%. That's not a small position and I want to be fully transparent in this video what I'm doing, why I'm still holding these shares, where I'll be buying more and how long I realistically think this will take time to recover. So, let's start with the obvious question of why did the trade desk drop so hard? The recent earning dropped about 15% after Q4 earnings. And here's the thing, the quarter itself wasn't bad. Revenue came in at $846.8 million, which was a slight beat. Adjusted EPS came in at 59 cents, which was also in line, and EBITDA also beat expectations. So, what went wrong was the guidance. They guided Q1 revenue to at least $678 million, and analysts wanted around $688 million. EBITDA guidance was also lighter than expected. So they beat their past records but disappointed on the future. For a growth stock, that's not a good sign. And zooming out even more, this stock is now down roughly 70 to 80% from its peak because of AI disruption fears in ad tech, Amazon getting more aggressive in demand side platform, growth slowing to around 14%, Q1 guidance showing only about 10% growth. This is the slowest in their company's history. The CFO departure shook confidence, and on top of that, the stock used to trade at 30 to 40 times revenue. It was priced for perfection. Now it's being repriced like a maturing ad platform instead of a hyper growth monster. That's a massive reset. Alright, now that we know why the stock is getting punished, let's get into the important topic of why I'm still holding this company. In my perspective, here's the thing, this company isn't burning cash. Trade Desk still generates strong free cash flow, their balance sheet is solid, and companies with real cash generation usually survives downturns. I've asked these questions to myself whether I should take loss and move on or hold on to it, and here they are. Do they have challenges? Yes, absolutely, just like any other businesses. Is the growth slowing? I would say yes, temporarily, but the business isn't broken. Digital advertising isn't disappearing, it's evolving, and the trade desk is still deeply embedded in the ecosystem. That's why I'm not panic selling. I know some of you will say, okay, but what's the upside here? My long term model shows 380% upside in 5 years. That puts the stock around $114. But this is with some assumptions on their growth rate, EPS, and other metrics. So let's forget assumptions for a moment and let me show you just pure historical math. Based on 5 year historical CAGR growth, stock price in 5 years should be about $72. Based on forward valuation multiples, it should be around $63. Based on free cash flow growth model, it should be around roughly $81. Even the most conservative of these is more than a double from year. And I'm not trying to convince you to buy or hold. I'm just sharing my perspective of this company and how I think. So please do your due diligence before buying any assets. All right. Now let me also show you how it's positioned technically. On both daily and weekly charts, RSI is around 20. That's extremely oversold territory. Now, does that guarantee a bounce tomorrow? Absolutely no. But historically, when stocks get stretched like this, some kind of reversal usually happens. So, let me tell you exactly what I'm doing. I'm holding my 450 shares and I'm not expecting this to recover in 1 year. That's unrealistic. For TT2 to double in 1 year, it would need a 100% move that rarely happens without a major catalyst. I recently replied to someone who said they are also holding TTD at $44 average and planning to wait a year. And I told them honestly, I'm in the same boat, but I don't think we hit those prices in just 1 year. So, my strategy is to slowly dollar cost average through 2026. If it drops to $20, I'll buy more. If it drops to $15, I'll buy even more. Instead of waiting for a miracle bounce, I'd rather lower my average gradually and position myself to be profitable over the next 1 to 2 years or even maybe 3 years. Before making a decision, let me also show you the risks involved here. I could be absolutely wrong on my thesis. I have been wrong in the past many times, but when I'm right, I hit the jackpot. All right. The risks I see for the trade desk are if the growth keeps slowing down, if Amazon keeps taking share, if ad budgets shrink in a recession, if leadership instability continues, then this could stay depressed for a very long time. That's the risk. But Here's how I look at it right now. Valuations have already reset. Sentiment is extremely negative. Technicals are oversold, but balance sheet is very solid. Those are usually the ingredients where long-term opportunities are built. So, no, I'm not selling my shares and I'm not expecting a 100% bounce next quarter. I'm playing the 2 to 5 year game here, accumulating slowly, staying realistic, and managing risk. If you're holding the trade desk, I'd love to know what's your average. Are you dollar cost averaging or are you waiting it out? Let me know in the comments below and let's discuss. That's all for this video. Thanks for watching and I'll see you in the next one.